Hi, everybody. This is John Vecchio from Hidden Profits, coming to you today trying to survive the polar vortex. So I hope that wherever you are, that you are warm and safe. In my last Rich Investor, I talked about a concept I call unbounded wealth, which is really the ability to break free of the man and live life on your own terms. And in order to do that, you really have to have specific mindset, I think separate from what other people do, in order to save and grow your wealth over time. And this is something that I've been doing since I started working, so 25 years ago, if not more. And it's what I call the George Costanza theory of investing. And that is, if you're familiar with the show Seinfeld, then you know George. George is one of the main characters who's always getting in some sort of pickle. And whether it's his wife dying from licking too many envelopes on their wedding, for their wedding, or George Steinbrenner yelling at him when he worked for the Yankees, all of his, charades end up being very funny. But in one episode in particular, George decides to do the exact opposite of everything that he thinks he should do, because his life really hasn't gone the way that he thought it would. And so by doing the exact opposite, he thinks, well, maybe something will work out for a change. And sure enough, it does. He meets a beautiful woman. His work prospects turn up. Everything's going great in his life just by doing the exact opposite of everything that he thinks that he should do. And really investing and saving is pretty much the same way. You should pretty much be doing the exact opposite of what everybody else is doing, because in the long run, the crowd is almost always wrong. I say the masses are asses. Like, they just totally don't know what they're doing. Human beings are preconditioned, I think, to just get ourselves in trouble, especially when it comes to money, and we follow crowds. To give you specific examples, for example, in the late 1990s, early 2000s, right around the time just before the internet bubble collapsed, individual investors had their largest allocation to equities ever. So they were most exposed to the stock market right before the internet bubble imploded. Fast forward a few years, and in March of 2009, right when the market bottomed, individual investors had the lowest position in equities ever. So in a generational buying opportunity, they were underexposed, and a lot of people missed out. So you need to do the exact opposite of what most people are thinking. It's also true for professional investors. Professional investors as a whole are terrible collectively in deciding when to allocate or not allocate to stocks. The track record is horrendous. So what can you do in the real world? You can pay attention to what other people are doing. So if you happen to be at a Christmas party or a holiday party and everyone's bragging about how much money they made in the stock market that particular year, you might take notice of that and wanting to pare back or raise your stops or reduce your risk in some fashion. By the same token, if everyone's jumping out the window or slashing their wrists and running under hot water because they're just bearing huge amounts of losses, that's when you want to probably get in pretty aggressive in the stock market. This also works, I think, in personal spending. For example, maybe 10, 11 years ago or so, I was in need of an automobile, and I actually kind of saw the market cracking in mid-2008. Back then, people were still talking about green shoots in the economy. People were pretty optimistic that there was going to be a turnaround in 2008 would end up being okay. And then the market crashed. So in 2009, in early 2009, as the market was continuing to crash, right around the time that it bottomed, I walked into an auto dealership, and I think they were shocked to see me, because guess how many people were actually in the auto dealership? Zero besides me. And that's when you get the best deals. You get the best deals when no one else has any money to spend. And when everyone else is just, throwing money around like it grows on trees and the party's never going to end, that's when you need to be cautious. So the George Costanza theory of investing is just doing the exact opposite of not only what everyone else is doing, but probably what you think you should be doing too. And to pay attention in the real world. Economists don't predict recessions because they don't live in the real world. They live in these ivory towers, and they all associate with each other. And so they all have sort of the same thoughts. So go out in the real world, pay attention to what other people are doing. Notice when they're fearful, notice when they're greedy, and use that to your advantage in how you allocate capital, how you spend money, and so that you can get the best deals, not only in stocks, but also in life, at the most opportune times. And that's really how you grow wealth over time, is just not doing what everybody else does. So I'll be back in my next TRI to talk about my next step in what I call unbounded wealth. Until then, see you around.